Welcome to the derivatives section of the CFA Level 2 curriculum. In this first lesson, we have an introduction to the pricing and valuation of forward contracts. We'll have a revision of the fundamentals in valuing the underlying and a revision on the application of arbitrage principles to the pricing and valuation of forwards. We'll learn pricing and valuation in the context of no benefits or costs to the underlying, followed by a quick discussion on the effect of benefits and costs. Just a bit of warning here, derivatives in general is a very difficult thing to comprehend, so please make sure you have a clear mind before you proceed. This lesson contains important fundamentals, so make sure you nail them before proceeding on with the rest of the course. So, if you're ready, let's jump right in. We've learned in Level 1 that derivatives are financial instruments that derive value from the performance of the underlying assets. The underlying can be financial assets like stocks and fixed income securities, physical assets like commodities, or even non-assets like interest rates, exchange rates, indices, or even weather. Let's first examine how underlying assets are priced. Although the specifics of pricing the various underlyings can differ, all of them are based on these four factors: expectations, risk, and the benefits and costs of holding a specific underlying. Let's start with expectations. We first assume that there is no benefit or cost associated with holding a particular asset. Some financial assets, like zero-coupon bonds, fulfill this criteria. An investor who wishes to determine the value of such an asset in the future just needs to estimate the expected future price based on its current spot price. Obviously, as with most risky assets, there is uncertainty in the expected future price. So, for an asset that has negligible holding costs or benefits, its expected future price is simply the spot price multiplied by the discount rate compounded over T periods. The discount rate is the sum of the risk-free rate plus the risk premium if it is a risky asset. Rearranging, the spot price is the expected future price discounted by the sum of the risk-free rate and the risk premium. For assets that come with interim benefits or costs, such factors should be considered in the valuation of the asset as well. Benefits to holding an asset can be either monetary or non-monetary. Dividend payments on a stock or interest payments on a bond are examples of monetary benefits of owning an asset. Non-monetary benefits are sometimes referred to as its convenience yield, which you learned in Level 1. This is only significant for some assets, primarily commodities. Assuming that such potential benefits of holding onto an asset are certain, the monetary value of such benefits should be discounted back to time zero using the risk-free rate. The present value of the benefits should be added to the spot price. Costs of holding onto an asset should also affect its price, particularly for commodities. One cost that is often incurred is the cost of storage. There are also costs incurred in protecting and insuring some commodities against theft or destruction. Likewise, the monetary value of such costs should be discounted back to time zero using the risk-free rate. The present value of the costs should be subtracted from the spot price. The net cost of holding an asset, considering both the costs and benefits of holding the asset, is known as the cost of carry. Taking into account all of these costs and benefits, we can describe the relationship between the current spot price of an asset with these four elements as such. Understanding how underlying assets are priced in the spot market is critical to understanding how derivatives are priced. To understand derivative pricing, it's necessary to establish a linkage between the derivative market and the spot market. That linkage occurs through arbitrage. Arbitrage is based on the law of one price, that is, two different securities with identical payoffs in the future should have the same price. Otherwise, an arbitrage opportunity exists. For most derivatives, the payoffs may not be identical, but they come directly from the value of the underlying at the expiration of the derivative. This property of derivatives allows investors to construct hedged portfolios. A hedged portfolio can be constructed by taking a position in the underlying and taking the opposite position in the derivative at the same time. This creates a portfolio with no uncertainty about its value at some future date. Let's say there is an asset that is traded at $100 at time zero. At this time, a forward contract that expires in exactly 1 year is priced at $103. So, an example of a hedged portfolio is if an investor longs the underlying asset at $100 at time zero and simultaneously enters the short position of the forward at a contract price of $103. Since there is no cash flow involved at the initiation of the forward, the net cash outflow from the investor at time zero is $100. At expiration, the investor is obligated to sell the asset at $103 to close the short position. The investor simply delivers the asset which he owns and collects $103 regardless of the market price of the asset at expiration. The investor earns $3 in a year or a 3% return without taking any risk of the underlying asset other than the counterparty risk. The investor will get a 3% return regardless of the price of the underlying at expiration. Now, let's bring back the asset pricing equation that we've learned earlier. Let's assume that holding the asset Y has negligible costs and benefits. The expected future price is therefore the spot price, compounded by risk-free rate plus risk premium. Let's assume also that the risk-free rate at time 0 is 3%. If that is true, this means that the risk premium in this case is 0. Now, we know that for a risk-averse investor, 0 risk premium would not hold. So is there a pricing error of the forward at time 0? For now, let's remember this forward price of $103, where the discount rate is equal to the risk-free rate. We call this the no arbitrage price, which we will explain later. Let's say the forward is priced with a 2% risk premium at $105 instead. If that is the case, an arbitrageur can sense the opportunity and borrow $100 at the risk-free rate of 3% to buy the asset. He will simultaneously enter a short position at the contract price of $105. At time 0, the net cash flow from the arbitrageur is actually 0. At expiration, the arbitrageur simply sells the asset for $105 to fulfill the contract and uses $103 from the proceeds to repay the loan. As you can see, the arbitrageur earns $2 without putting in any cash. At this point, it is important to point out the rules of an arbitrageur. Firstly, he does not use his own money. In this example, he borrows the money at risk-free rate to finance the purchase. Secondly, he does not take any price risk. As shown in this example, there is no risk involved as there is no uncertainty in cash flow. He simply needs to execute the steps to earn the 2% yield. This principle assumes that transactions costs are 0, there are no restrictions on short sales, and both borrowing and lending can be done in unlimited amounts at the risk-free rate of interest. What we've illustrated here is an example of the carry arbitrage model or cost of carry model. In this simple model, we have assumed that there are no carrying costs associated with the underlying asset. We will consider carrying costs later in this lesson. For this particular case, the forward is priced above its no arbitrage price. The arbitrage transactions can be represented in 3 steps. Purchase the underlying using funds borrowed at the risk-free rate and sell the forward contract on the underlying. In the opposite situation, where the forward is priced below the no arbitrage price, the arbitrageur should perform the reverse. The steps are to short sell the underlying, use the cash from the sale and invest at risk-free rate, and long the forward contract. This is known as the reverse carry arbitrage model, which we will go through at the end of this lesson. Be it a carry arbitrage or reverse carry arbitrage, we know that such arbitrage opportunities cannot last for long, for when many arbitrageurs realize the opportunity, the buying pressure on asset Y will push its price up, and the increase in shorts will push the forward price down. This continues until the forward price returns of this portfolio is equal to the risk-free rate of 3%, when no arbitrage is possible and the risk premium is 0. The important point from this illustration is that while the risk aversion of investors is relevant to pricing assets, it's not relevant to pricing derivatives. As such, derivatives pricing is sometimes called risk-neutral pricing. So, based on the principles of no arbitrage and risk-neutral pricing, only one price can exist for the derivative. We call this the no arbitrage derivative price. This risk-neutral pricing relationship specifies the pricing of the forward at the initiation of the contract. In general, any time t, we can calculate the arbitrage-free price of the contract, which is the spot price at time t, compounded to maturity by the risk-free rate. For example, if the maturity of the forward is 1 year, and half a year after initiation the spot price is $104, the forward price of this contract would be $105.55. It is important at this point to note that we have assumed that there are no carrying benefits or costs associated with the underlying. We shall study the effect of such benefits or costs later in this lesson. The notion about derivative pricing is often somewhat confusing to most people. When we say that the forward contract is priced at $105, it doesn't mean that one would buy or sell this contract at $105 at this point. Rather, it only means that if a new forward contract with expiration at time t is initiated, the forward price on the contract should be $105. Remember this distinction, for it'll help clear a lot of your confusion later. When we refer to forward price, we're talking about contract price for a future transaction. Another source of confusion is differentiation between present value and future value. For forward contracts, prices are determined at contract initiation, but these are not present values. Rather, they are future values. To aid in our illustration, we move the forward prices to the expiration date. Assuming no carrying benefits or costs, F0 is simply the future value of S0 and FT is the future value of ST. The value of a derivative contract is also different from our notion of value. In essence, the value is the worth of the contract to the contract holder, so it differs between the long and the short. For forward contracts, the value to the short is exactly opposite that of the value to the long. For simplicity, we shall mainly explain value from the long's perspective. We first plot this dotted line which connects the spot price at initiation and the forward price at initiation. This line represents the present value of the forward price. To calculate this, we discount F0 by the risk-free rate over the remaining time to maturity. So, in general, at any time t, this is the general expression to calculate the PV of F0. So what's the significance of this line to the value of the forward? Fundamentally, the value to the long at any time t is the PV of the increase in forward price over the initial forward price stated in the contract. As we mentioned earlier, the forward prices are future values, so we discount them to time t using the risk-free rates. We already mentioned the PV of F0. For this particular case, where there are no carrying benefits or costs, the PV of FT is simply ST. Therefore, the value to the long at any time is the spot price minus the PV of the forward price. At initiation, this works out to 0 for both the long and the short, consistent with our understanding of forward contracts. At the half-year mark, where the spot price is $104, the value to the long would be $2.51 and minus $2.51 to the short. And at expiration, the value to the long would be simply the spot price minus the forward price. So if the asset spot price falls to $101, the value to the long would be minus $2. The long would have to pay the short $2 to settle the contract. In essence, this is the general formula of the value to the long at any time t. Do note that this is based on the assumption of no carrying benefits or costs for the underlying asset. Let's now take away this assumption and study how carrying benefits and costs affect the pricing and valuation of forward contracts. We've determined earlier that the no arbitrage forward price at any time is simply the future value of the spot price of the underlying if there are no benefits or costs on the underlying assets. For simplicity in notation, we shall use FV and PV from now on. The key to understanding this part is to keep in mind that the short holds on to the underlying asset until delivery to the long at expiration, so it is the short who receives the benefits and bears the costs during this period. Essentially, the price of the forward is what the long pays for the asset at expiration, so it should not just depend on the spot price, but also adjust according to the benefits and costs of the underlying that he has missed out. If there are carry benefits, we should deduct the benefits such that the long is compensated for foregoing the benefits. Likewise, if there are costs, we should add the costs such that the short is compensated for bearing the costs. So essentially, the forward price at any time is the future value of the spot price minus the carrying benefits plus the carrying costs for the period. The discount rate must be the risk-free rate to produce no arbitrage values. Once we have the price of the contract at initiation and at time t, the value of the forward to the long is the PV of the increase in price, as we've learnt earlier, and the value to the short is the reverse of that. To illustrate, the PV of F0 should be somewhere here, and the PV of FT should be somewhere here, and the value to the long is the difference between the two. Just that in this case, the spot price may not be equal to the PV of FT, if we consider carry benefits and costs in the pricing. These three equations are the important takeaways for this lesson, where we've looked at the pricing and valuation of forwards for a generic asset. Different types of assets will have different carrying benefits and carrying costs. For example, equities come with dividends as benefits, fixed income instruments come with coupons, while commodities come with costs like storage costs. In the coming lessons, we shall expand on these to be more specific for equity and fixed income forwards. Let's end this lesson with an exercise. The spot price of an asset is currently $300 per unit. The 2-year forward price on 1 unit of the asset is proposed to be $330. The risk-free rate is 5%. Assuming that there are no carrying benefits or costs, determine if there is an arbitrage opportunity and outline the steps to benefit from the arbitrage opportunity. Pause the video now and work out your answer. And we're back. Let's first determine the no arbitrage price for the forward, which is the future value based on the risk-free rate. This works out to $330.75, which is different from what is proposed. If the forward is priced at $330, there would be an arbitrage opportunity. As this price is lower than the no arbitrage price, the reverse carry arbitrage method should be used by the arbitrageur, which is to short sell the asset, lend and long forward. At initiation, the arbitrageur should short sell the asset and receive $300 as the proceeds. She would immediately lend out this amount for 2 years at the risk-free rate. She would also long a forward to buy the asset for $330 in 2 years. The net cash from the arbitrageur is zero. 2 years later, she would receive from the loan $330.75 with interest. She would use $330 to buy the asset to settle the forward contract and deliver the asset to close the short position on the asset. She pockets 75 cents risk-free without using her own cash. Next, knowing that forward is mispriced, two parties decide to enter into a forward contract with $330.75 as the forward price instead. 6 months after contract initiation, the spot price fell to $285. What is the price of the forward contract and value to the long? Pause the video now and work out your answer. And we're back. Let's first draw a timeline. The 2-year contract was initiated with a forward price of $330.75. This is the no arbitrage price. At t equals 0.5, the spot price went down to $285. As we learned earlier, the forward price is the forward price if a new contract with the same expiration date is initiated based on the current spot rate. So since the spot price is now $285 and there is 1.5 years to maturity, the forward price should be $306.64. And for an underlying asset with zero carrying benefit and cost, the value to the long is simply the spot price minus the PV of the original forward price. This works out to minus $22.41. And phew, your head may be spinning right now. As mentioned earlier, these are the fundamentals of derivative pricing, so do repeat this lesson if you need to. In our next lesson, we go into the specifics of valuing